Retirement Incentive Program. It provides an incentive to people with 25, 30, and 35 years of service to retire. Just right off the bat, the plan does not require that you actually retire from teaching in order to benefit from the payments in the plan. If you have 25 years through 29 years, or a fraction thereof, we are providing 25% of your final year salary paid out in 5 installments starting next September. If it's 30 years through 34 years, it's 50%. If it's 35 years or more, it's 75% of your last year's salary paid out 5 equal installments. One of the benefits of the plan is if you do actually retire, it helps you to pay for your medical insurance through the time you hit Medicare. And the way that works is we will be amending the board's flexible spending section 125 plan to allow you to put the money or a portion of the money into that plan to help you pay pre-tax for the insurance. Under state law, we have to carry your insurance at your expense if you are retired through the time you hit Medicare. So that is a big obstacle that we've been told for some people who would like to retire but need the medical insurance. That's what that is there for. There's a lot of the deadline to state your intentions, and you provided a form that you need to use and to submit your resignation is January 16th. The board could revoke the plan if we don't get enough people. We've set that number at 75. And if that happens, any letters of resignation and whatnot become null and void. It's almost like it never happened. There are provisions to amend the plan. So, for instance, you'll see there's a maximum number of 125 in the plan, or 35 people in shortage areas. If that happens, we've discussed with the union, and what we would do is, if the board didn't revoke and still wanted to do the plan, it would be in order of seniority. And after that, we would look at years of service, years of teaching service. So it's not first come, first served. It's not if you rush in the door first, you're automatic. You have your time to meet with your advisor, your financial advisor, think about it. And if you do go over the 125, that is something we would have to look at. Other than that, that's the basic outline. I know there's questions. We got a lot of them last week. One of the things we're going to be doing is at the end of these 3 sessions, the last one is next Monday at 4 o'clock over at Broadview. And we're going to put out a memo of the frequently asked questions, timelines for doing things, explain a little more how the flexible spending account will work, that kind of thing. And then, it'll be the holidays and everyone will have time to think some more about what they want to do. And that's the broad strokes. Is there any questions? Yes.
The insurance part of this, and this is the lump sum amount. What I understood is it would be divided up into 5 increments, and you would get one each year.
Yes.
I've also heard that one of the meetings was that it was opted for lump sum. And my other question is about the insurance. If you are in a family plan now, for instance, my husband and my son are on my plan, would that be also included or not? Is it just one individual staff member?
I'm going to let Elio Longo, our Director of Finance, answer the last part of your question, and then I'll address the first part.
Good afternoon. Post-employment for retirement, we afford our educators to continue with our current healthcare package for the retiree and spouse. Does not apply to family members, not involved.
That would be the employee and the spouse.
That is correct.
Right.
Even though like now they have that law that 1 through 26 years old, it's 1
That's correct.
So even if your child does qualify for that, your child would not be included?
Yes, there are. We're aware of the new standards that have recently been issued on it. We're still looking into the new standards as well. My understanding today is, again, that it only applies to the retiree and the spouse, and not for dependent coverage post-employment. Absolutely.
And we'll get a firm answer to that, too, for our memo.
I mean, I thought it myself.
Right. As to your first question on the lump sum issue, each year you're going to get a lump sum on September 1st of each year. You have to elect if you want that money to go into your 125 plan on an annual basis. So let's say first year you're owed $13,000. You can either take that or some portion of it and put it into your 125 plan. We're going to be amending the board's Section 125 flexible spending account so that you can use pre-tax dollars to pay for the insurance. If you choose to put the money in there, then that's where it goes, and it's used to pay your cost for the plan that we were just discussing. If you don't, and you just want the lump sum, withholdings will be taken, as always, and you will get the lump sum.
Just clarity on the lump sum. The lump sum is the annual payment due.
Right.
It's always spread over 5 years.
Okay.
Yes.
It's 20% of the total amount.
It's still being split 20% per year.
Oh. No,
No.
I'm afraid not. That would be too expensive for us.
Okay. And then, if I'm not clear on that, maybe so if you put that into account, maybe the insurance,
Yeah.
we're talking 12,000, and then approximately, depending on where we are in safety on that, that would be enough to cover both the member plus the spouse?
That depends on, you're right. I mean, it depends on how much you're getting. I'm not sure what the cost would be. Maybe you can answer that.
Currently, $12,000 would cover the cost for one insured. $12,000 does not cover the cost of the spouse.
Therefore, the spouse really, even though they are covered, they're really not covered. In other words, it's not.
It's 1,000 for one? Singles
You
1,000?
have to pay additional for the spouse, so this plan really doesn't pay for both, is what I'm saying. It doesn't cover enough money.
No, the foundation of the plan is to offer a monetary incentive, and the monetary incentive amounts to the highest tier to 75%. We're providing a payout option to assist our educators in the retirement years to afford health care for themselves.
But the
So then,
sequel.
when you were speaking of the insurance part of the spouse, what you're saying is the spouse can elect to have the spouse and include it in the coverage.
Yes.
But it would not be part of the payment plan, because it wouldn't be enough money.
Well, let me clarify that. If single coverage today costs $9,000,
Right.
and the agreement affords you $12,000 annually for the next 5 years, then the first $9,000 would cover the cost of the employee or retiree. The balance of $3,000, the district, should you elect the 125 plan, we can then apply the balance of the $3,000 towards the cost of the spouse coverage.
Otherwise, you get it back.
That's correct. That's right. If you have $12,000 allowance and either your spouse holds insurance or simply you're not married, then on the $12,000 you can apply, and these are just using some hypothetical numbers, $9,000 towards insurance coverage through the flex plan, which affords you a tax benefit on the $9,000. The balance of the $3,000, a lump sum in the year payment.
Yes.
How much is it?
We'd have to choose
So
singles,
it's
right?
about 9,000. So it's about 9,000 for a single person. How much is it for a single person and a spouse?
It's actually you would purchase 2 individual plans.
You got the plan. $18,000. You have to purchase $18,000.
If we use the hypothetical 9, probably a little less than $9,000, but
Yeah,
yes,
it's a little less.
you would pay or purchase 2 individual plans.
Yeah. Back there.
Say I want to take some of the money and keep it into the flexible spending account, but I want to take part of the money, can I do that? Get on something?
Yes.
Yeah.
You just, the
That's
trick
what
is,
I've been doing, you know?
right, once you put the money in, it can't come out. So,
understand.
right, but yes, you can elect how much you want to use.
How much you want to put in? Okay, I could still use it for my benefits.
Yeah. Also be mindful that as a retiree if you elect to retire from the state, from the PRD, you then are entitled to a subsidy through the PRD as well too. I believe currently it's $110 for both the retiree and the spouse.
220.
So it's about the 220. That should you retire from the state. Yes.
Yes.
Well, that also assumes that you're not eligible for Medicare.
Then you don't have to worry.
Right.
Right, if you're eligible for Medicare, and Bill will probably talk more about it later, but you're eligible for the supplement plan through the state, which is a very good deal.
Right. The supplement would be the 220, 110 per person.
Yes, for the supplement, that's through the TRD. The plan as we rolled it out and defined the plan, does not require an employee to retire from the state TRD program. It does not require it.
Right.
Should you elect to retire from the state TRD, then you are entitled to the state
Insurance.
subsidy.
That's after.
Do you still have a question here?
So if you're like with the Sterling and the Medicare,
Yes.
then you could take the 20%.
I'm not sure of the 20%
Of the
deduction.
70, you said 75% of your salary
Yes.
divided over 5 years.
Right.
So,
Could you apply it to the supplement is what you're asking?
yeah, then you,
Well, the way, I don't know. I don't think.
Look, I can answer that question. If you
It's a
enroll
tough
in
one.
the TRD plan,
Yeah.
okay, there will be a payroll deduction from your retirement check for the Sterling plan,
okay.
okay? So you would then get your supplement, your retirement incentive program through Danbury directly.
Right, and since they're deducting it from the retirement check, it's not taxable anyway. Or is it?
It is taxable because the retirement board doesn't have a section 125 plan.
So if I understand the question correctly, the only tax benefit to the retiree is to remain on the district's plan. If you're enrolled in the Sterling and Sterling, the payment would first pass hands from the district to you as a retiree, as a former employee of the district. Therefore, there is not a benefit, a tax benefit, as you make payments to Sterling and Sterling. The tax benefits can only be realized if you were to continue with the district's plan.
Which is $9,000.
Well, again, a hypothetical number, I can report back the actual number for our retirees, but for hypothetically speaking, yes, we can use an example of $9,000.
Before we make the decision to put money into a 125, then we would know the actual cost of the insurance.
You would know the actual cost of the insurance, well, you would know, I mean,
You would let people know that.
except for, we don't have renewal rates as of yet for next fiscal year on it. So I can provide you with this year's rates and a projection going forward, but I can't guarantee the rate effective July 1 of '09. Absolutely.
And could you tell me what the cost for Sterling and Sterling would be for coverage?
Yeah, I think right now, I think the best plan they offer is somewhere around $150 a month for an individual. So that's the supplement. That's $1,800 a year for an individual, and you compare that to, say, $9,000 for an individual through Danbury. It's a big difference.
That's what Medicare.
That's what,
That's what Medicare.
right, the Medicare B premium, you pay the Medicare B premium on top of that, which is about $97 per month. So collectively, you're looking at maybe $250 between the Sterling premium and the Medicare B premium. So, and it's a great plan too, excellent plan.
I mean, it's a sensible plan for those who have reached Medicare eligible age requirement on it. The plan that we've designed is to afford retirees who are short a few years of the medical eligible age to purchase through the district a plan and have a sponsorship in the form of a retirement incentive.
So if I'm on the Sterling with Medicare, then September 1st, send your record to me, my first
Yes.
1/5 payment.
That's correct.
I just like to get to that supplement thing again. If I'm going to get to the Sterling and Medicare, which I probably am going to be doing, I want to still get to some of the flexible, because I know that there is a deductible that the Part B is Sterling and Sterling. And I still do it. The 125.
There are some deductibles under the Sterling plan. Okay, like for example, the prescription drug program, it's a $250 annual deductible.
Is that the only one that's under?
You probably have, usually there's a Medicare Part D deductible, which I think is $100, and then you're going to have co-pays, all right? But at this juncture, and I'm going to talk to the folks at the retirement board to see if it's going to be possible to set up a Section 125.
Oh, there.
over there.
So I don't have to worry about it.
Right, so I'm gonna see if that's feasible to do that,
That's
okay,
what I
because it
wanna
would make
do,
sense.
because I would like to be able to have that
Sure.
money,
It does make sense.
Yeah.
tax-free money going into
Yeah.
it, because that's the understanding for me.
Just ready to go. Green shirt, I'm sorry, I don't know your name.
I just, recommend you one a month, is that a month?
I'm sorry, how much?
TRB
The
subsidy.
TRB premium,
12 months or 10 months?
it's 12 months a year. Okay, so it's approximately, I think January 1st, it's somewhere around $150. I do have the rates on one of my slides. Okay, the latest rate. So it's $150 a month for a month for 12
No, no,
months.
the 110, that's with that,
The 110 coming to the board is 12 months.
12 months,
Yeah.
so it's 110.
Right, so basically you're getting $1,320 towards your health insurance.
Now, if you qualify for Medicare and want yourself in Sterling, do they get the one, do you no longer get the 110?
It's all factored in. Basically, when you, right, it's factored in. You pay a third, the state pays a third, and the health fund pays a third, so. Exactly. Right.
Right, because the 110 goes to Sterling,
Yeah.
yeah, I got it.
Any other questions on the program itself? Okay.
Did you go over the dates you said were in?
Yeah, I'll just say them again. The relevant dates are by January 16th, which is a Friday at 4 p.m., Dr. Sal would need to receive the notice of election, it's all on one form, and the resignation. After that, we won't be accepting anymore. Also, after that time, it becomes irrevocable. Okay, so you can't come back in February and say, oh, no, I'm not resigning. That would be a irrevocable resignation. Now, on the other hand, if come February, March, it looks like, we've been wrestling with it, board decides, you know what, we didn't get enough people. And then they decide to revoke it. Or they get way too many people, and we don't. They decide we're going to revoke it rather than amend it. What would happen then is your resignation becomes null and void. You're still unemployed, and you will be next year. So that's how it works. It's it's set up to provide a date certain so there's no confusion, but at the same time it provides the board an out, and it lets you off the hook essentially. No one's trying to trick anyone into doing anything. This is supposed to be for everyone's benefit. So those are really the relevant dates. Now, March 31st is the date that's in there for the board to sort of make up its mind. I expect they would do that before that, but I can't guarantee that. March 31st is the latest date the board can either revoke it or amend it. As I described before, we've been discussing.
School time is now 3:29, approximately, second. And all students make their move to the second class. Those of you in a high school tutor waiting for you, please don't let them wait too long. Everyone get your belongings together, walk in the hallway, go running, pushing and shoving.
You hear that?
Your acquaintance leave, screaming and shouting. You know the
Got it.
routine, so it's good. Come on there. That's the second hour.
All right, thank you. But as I said, the board may choose not to revoke it. If they get fewer, I think they're going to revoke it, frankly. But if we go over the 125 or the 35 shortage area teachers, we've discussed with the union some procedures that would take place if the board were to amend. And basically, it would be seniority first. Second, in equal seniority, we look at years of teaching. Hopefully that doesn't happen. Hopefully we get between 75 and 125 and don't hit too many shortage areas and we'll be okay. But that's where that is. Yes? No, it's seniority in the district. So if in the district, you're right. So that would be the first. Correct, and that's why that's the second tier, and that would only be the break ties. That's correct, as recognized by TRB. So, for instance, if someone's bought 2 years, that would count towards the years of service. But the first would be seniority. Hopefully, that would solve the problem. And hopefully, we get so many that that's a problem. We'll see.
Do you have a number so far?
22 as of today. It's pretty good. We got a month left to go, and it's it's a pretty significant. If you look around, it's a pretty significant benefit compared to other trying to figure out what we're doing. So, hopefully everyone sees it as a fair plan. Yes?
Just as a clarification, I'm in 34.8 years according to TRB at the end of this year.
Yeah.
I do have
Hardly
time
again.
that I can buy
Clearly,
back.
custodian unlock the supply room.
Will that put me at
Please,
35
the
in
supply room,
districts?
unlock the gym. Thank you.
I'm sorry.
So that
You're being interrupted by that. I can't.
for the percentage that I would receive
Yeah.
as my buyback time counts.
We don't, the district is not going to be having its own buyback program. The way it works, as far as the program is concerned, is if you can buy back sufficient time from TRB, that counts.
Okay.
So if you've got 34.8, you're buying back 6 months, then yeah, you got 35.
Do you have to buy it back
Before June 30th, before the end of the year. The way we wrote it is as of June 30th, your teaching experience would be X. That's the way it would work.
Yeah, in fact, to get credit with the retirement system, you have to make that purchase prior to retirement, so you would have to make that purchase before June 30th.
75% is based on the salary, the current salary.
I'm sorry?
Yes, current salary.
35, right, 35,
Current salary.
right, if you have 35 years as recognized by TRB, you would then get 75% of your salary,
This year's salary.
this year's salary.
Now, just talk to them about applying for that, even if they're intending on going July 1st. How long does it take that verification process?
Okay, that's a very good question. I would start, if you have time to buy in, for example, like leaves of absence, subbing, out-of-state military, any type of service, do it ASAP. Even if you decide not to retire this year, for whatever reason, because the longer you wait, the more difficult it will be to get that documentation. And especially if you've been out of state and you've taught in multiple towns, you're going to have a tough time trying to get that documented. And the other one that's flood times is difficult to document is subbing. So if you were a substitute teacher back in 1969 and you go into the superintendent's office on June 15th and say, I need to get this documented, you may run into a real problem. So I would
And that's
encourage
just
you.
Connecticut sub.
Connecticut subbing, right. Okay. But there's a list. Actually, there's about 14 or 15 types of different service that you can purchase. Okay. But do it now. Yes.
If I buy a half year of New York State teaching time, does that count
Absolutely.
as time?
Does it become a
Right.
half year? Is it a quarter year?
Well, if you buy half a year, which would be 5 months because it's a 10-month school year, then that will count just as same as your Connecticut service.
It will.
Yes.
And
For every 18 days is equivalent to 1 month.
for subbing.
For sub.
For subbing. So if you
They
sub-
have a formula.
Yeah.
And anything you buy from out of state, it could be from Hawaii, it doesn't really matter. As long as TRB accepts it, then it'll apply in your retirement. That's the criteria from TRB, not from us necessarily.
Yeah, I would think that procedurally, if there's an issue, say you have 34.8, get it documented, and TRB will send you a statement or an invoice for the amount of time. Okay, and then you can have that as documentation.
If that goes in, TRB seems, they say it takes a very long time for them to process. Will that be a detriment to this, or does it have to be by June 30th?
Okay, normally, right now, I think they're processing service credit requests back to last March.
Right.
Okay? But if you file your retirement application, they put you on fast track.
They have to figure out how much money you're going to.
Right, because, you're going to get a priority. Because typically they have 1,500 people who retire July 1st. So as soon as you get that retirement application, then they'll move you right up.
I just got it. Well, June, I've been trying to get all my facts and that. And I called last week, whatever, or something. Anyway, I asked those questions, and mine's kind of messy. I got some trouble with different leagues I took the kids. And they said, get it right away, but they also sent the paper to me the next day. So they were really very helpful if you know that it's a system that's,
Right.
so they'll do it for you as quickly as possible. Because if you're trying to figure out the money before, January 16th.
Right.
Make a decision. Does it right away.
And if you file your paper with the state, then the whole thing falls through. You're not obligated to do the paperwork, and then it just becomes a
That's right. How
Right.
late is
revoke your retirement with the state?
Well, technically, if you're going to retire July 1st, you can actually file your retirement application with the state up until June 30th. But if you file, we'll say in January or February, conversely, you have until June 30th to revoke that. So as long as you do everything by June 30th, you're fine. Okay?
And they have to pay you until July 1st?
Well, if your effective date is July 1st, say you file your retirement application, it becomes effective July 1st, you will actually get your first benefit payments at the end of August. But it'll be retroactive, so you'll get a payment for July and a payment for August. Right, double check. Then thereafter is the last business day of each month.
Anything else on the district board? The bill has a lot of information about the actual retirement process that's very helpful, so, because otherwise I'll just sort of let him start his program. Any other questions, though? Just raise your hand.
As Sal mentioned, I was with the retirement board probably for about 33 years. In fact, I was a recipient of the last early retirement program offered by the state. So they made an offer I couldn't refuse.
Can you focus that, please? I'm sorry? Can you focus that, please?
Twice. That's as far as I can get.
Move the machine.
Yeah, you have to be creative.
That's better.
Okay, what I'm going to start off with, this is basically the agenda. Speak briefly about the eligibility rules. State teaching. Talk about deferring benefits and terminal leaves, taxability of benefits, social security benefits, cost of living adjustments, health insurance, disability benefits, pre-retirement death benefits, post-retirement employment, filing for retirement, and things to consider before you retire. Time constraints, I will probably move on fairly quickly on some of these topics. Okay. The eligibility rules for retirement, basically they're based on a combination of different factors. They're based on your age, they're based on your years of service, and they're based on your highest 3-year average salary. Now, normal retirement is age 60 with 20 years of Connecticut service, or any age with 35 years of service. And the benefit formula in that case is 2% per year. So if you have 35 years of service, let's say you have 32 years in Connecticut, you buy 3 years of out-of-state teaching, you have 35 years as normal retirement. You can also take early retirement, which is any age with 25 years of service. You have to have at least a minimum of 20 years of Connecticut service. You can also retire at age 55 with 20 years of Connecticut service, provided you have at least 15 years in Connecticut. I want to point out that the early retirement factors change substantially when you have 30 years of service. It's a fairly substantial difference, and I'll show you a table which will illustrate that. The reduction in your benefit for early retirement is based upon the number of years your early retirement date precedes your normal retirement date. So if I'm 58 and I have, let's say, 28 years, my normal retirement date is going to be 60. If I'm 52 with 33 years, I'm 2 years early because I'm 2 years away from the 35 mark. There's also another type of retirement, which is called a proratable retirement. And this is a type of retirement where you've completed at least 10 years of Connecticut service, but less than the 20, and you've completed the service on or after age 60. That benefit formula can range anywhere from 1% per year to 1.99% per year. So if I retire, we'll say at age 62, with 10 years of service, I would get 10% of my salary. If I have 12 years, the benefit percentage would be 1.2%, and I would get 14.4%. In this particular benefit formula, the non-Connecticut service is only worth 1%. So if I retire, say, with 14 years in Connecticut, and I'm buying 2 years of out of state, I would get 1.4% for the Connecticut years, and I would get 1% per year for the 2 years of out of state. Okay? And for the most part, if you're a career teacher, and as I mentioned before, you have 32 years and you buy 3 years of out of state, it's all going to be worth the same. It's all going to be 2%. The last benefit formula, which really probably wouldn't apply to anybody in this room, is what they call deferred vested. So this is where you completed 10 years of service prior to age 60. You left the system, and then you collect the benefit at age 60. And that benefit formula can range from a low of 1% to as high as 2%. Okay? Okay, just to keep things simple, this is a table that was developed by the retirement board. Essentially, you can look at that table and look based on your age and service and see pretty much what percentage you would receive of your highest 3-year average salary. And I know it's hard to see, but let's take an example here. A teacher who's age 54 with 29 years of service. You can see the benefit is 38.28%. We go one more year, that benefit jumps to 51%. So that's a big swing. You're going from 38.28% to 51%. And I want to emphasize too, when it comes to service, the retirement board does a very good job of tracking your salary, your credit, and all of the other data, but it's not perfect. Especially if you've had breaks in service, you've gone in and out of the system, you've gone from part-time to full-time. It's very important that you scrutinize your statement to make sure that you're comfortable with it. Because, I mean, there are situations that I've come across, during my tenure at TRB, where someone thought they had 25 years, they thought they had 30. There was a data error. For example, classic one would be, let's say you started in October of the school year, and October of 1982. So you get your annual statement every year. It shows a year, 10 months. So you expect at the end of this year to have 27, 1982 to 2009. Well, because you started in October, it's probably a reporting error. You only have 26.8. Right? That case is not going to make a big difference. But if it ended up where I thought I had 25, and I only had 24.8, and I can't retire. Or the other situation would be, I thought I had 30, and I have 29.9. So it's very important that you look at your annual statement. If you have any questions about it, contact the retirement board. Yes?
When is the annual statement coming out?
They should be out, I would say, within hopefully the next week and a half. But check your statement. Okay, it's very important. Okay. Anyone here work part-time? Oh, why not? Okay. So if you work part-time.
Before 1970.
I'm sorry?
Before 1977, so what?
Okay, if it's before 1977, no problem. Okay, it's treated just as if it's full-time. It's after 77.
Right, yeah.
So the regulations affecting part-time service didn't come in until 77. So they weren't applied retroactively.
Okay.
So they were applied prospectively. But after 77, the retirement board looks at what your FTE is. Now, it's treated the same as full-time service for purposes of qualifying for your benefits. So if you work 20 years half-time, it's still 20 years. What happens, though, it does affect the benefit formula, ultimately in terms of how they calculate your benefit. The other thing, too, is the part-time salaries, okay, if they happen to be part of in your last 3 years, the retirement board would annualize those to full-time. So you wouldn't be getting a double hit. So here's an example of a teacher who's age 57 with 30 years of service. The first 25 were full-time. The last 5 were 50% time. So in aggregate, that teacher has worked 91.67%, what a full-time teacher has worked. And salaries for the last 3 years were 30, 32, and 34. So the retirement board would treat those as full-time, 60, 64, and 68. Don't put an average of 64,000. So the way the retirement board would figure the benefit formula, it's an early retirement. So the benefit formula would be 25 years times 1.82% for the full-time years, and it would be 5 years times 1.82% times 50% for the half-time years. So in aggregate, that teacher would then receive 50.05% of the highest 3-year average salary. Any questions on part-time service? Yes, you have a look there.
Yeah, I'm affected by it. Just trying to see that 1.82. They told me I could never reach 100% because I had 2 years
You
of
could,
part-time.
you could never reach 100%. In other words,
Even if I put,
in this
40
example
years.
here, this teacher is retiring 3 years early. Okay? They're age 57 for 30 years, so they're 3 years away from 60. So the benefit formula says you will get 1.82% for each year of full-time service. And for any year that was less than half-time, less
because
than full-time.
25, but what if you've reached 37 years?
You had what?
37 years.
Okay, give me an
So-
example. You have 37 years.
37 years.
Okay,
and
very simple.
I have 2 of
Full-
those years of part-time.
Right, your full-time years are worth 2%.
Right.
Right? Your part-time years, say you had 1 year at 50%,
Right, and 2 at 50.
and 2 years at 60%. So the 1 year at 50% would be worth 1%, which is half of 2%. The 60% years would be worth 1.2%. Now I recall coming across teachers who had 40 plus years, but a lot of it was part-time. So even though they had over 37 and a half years, they still wouldn't hit the 75% mark. So I could work 50 years and at half time, and I still would not hit the 75% mark. Okay. But if you had 30, so you have 34 years full-time, 3 part-time, so it's 2% for the 34 years.
And 1%.
50% will say that 1 year,
Yeah.
60% for 2. So it's a marginal, it's a minimal decrease in your benefit.
So you tell me it's like 97%. Which one is up to a couple, $1,000?
Sorry?
So I'm not sure. I guess I have to be, so I should be getting 1% for each of those half years.
Right,
and
what
for
you can
full
do-
years.
you
So I
get-
should have 72% is what you're
When you
saying
get your
right
annual
now.
statement,
Pardon me?
when you get your annual statement, maybe next week or 2,
Right.
it will probably show you're going to have 36 years at the end, last year,
I'll have 37 now.
now or
Oh,
2009.
I'm sorry, right, it'll be 36 is when this one.
Right, so what it will say is, on your annual statement, you have 36 years at, we'll say 98.7% FTE. So essentially, you will receive about 98.7%, using that example, of what the full benefit would have been had you worked full-time.
But I could reach the 75%, you're saying, if I put enough full-time years in. I
But
could still
you had,
reach it.
to get, normally, a full-time teacher would max out at 37 and a half.
Right, which would be fine, but they're saying I can never
Right.
reach it.
But it's going to be a
Okay.
minimal reduction because you had 2 or 3 years at part-time. Okay?
Thank you.
Okay, I'm going to spend probably the next 10 or 15 minutes talking about retirement payment plan options. And essentially, when you retire, you have to make a decision as to what payment plan option you want. And you have 3 choices. You take Plan N, which is a normal retirement benefit. It gives you the maximum benefit. You can name 1 or more beneficiaries, and you can change your beneficiaries at any time after you retire.
The other plan's a Plan C, which is called a period certain and continuous option. That would be a reduced benefit, okay? You can name one or more beneficiaries, and you can change your beneficiaries anytime you want. You can have multiple beneficiaries, and you can change it. The other plan, the last plan, is Plan D, which is called the co-participant option. And again, that's a reduced benefit. Big difference with Plan D is you can only name one co-participant, and you can never change it. It's for life. Now, regardless of which plan you select, it's going to be payable for your lifetime. The key thing to remember is that once you retire, okay, you cannot change your plan. So if you retire July 1st and on July 5th, you decide you want to change your plan from Plan N to Plan C or Plan D, you can't do it. You're locked in. So this is why it's a very important decision to make. Okay. People will ask me, what's the best plan? I can tell you statistically, about 75% of retirees will take Plan N. Probably about 7% will take Plan C, and 18% will take Plan D. But when you choose the plan, you're going to choose it based on your own income needs and those of the person you want to protect. So when you take a retirement payment plan, it's almost like buying life insurance. And the more protection you want for your beneficiary, your co-participant, the more expensive it's going to be. Okay. Now, the options are generally affected by your age at retirement, the length of the period certain, selected if you're taking Plan C. If you're taking Plan D, it's going to be based on your co-participant's age as well. It's also going to be based upon how much of your pension you want left to your co-participant when you die. Okay? So I'm going to show an example. Okay. This is a teacher who's age 56, 33 years full-time service, average salary of $72,000. The spouse was age 55. So this is an early retirement. Teachers retiring 2 years early. So instead of getting 2% a year, it's 1.88%. So the base percentage will be 62.04%. And when that teacher retired, he or she had a balance in their retirement account, their regular account, of $240,000. So for Plan N, very straightforward. You take the average salary in the top 3 years times 62.04%. Annual benefit is $44,688 divided by 12, and the monthly benefit is $3,722.40 per month. Again, it's payable for life. Now, what happens under Plan N, if you die, the retirement board will take 25% of each monthly payment and subtract that from the account balance. So, the retiree had $240,000 at the time of retirement, and up to the time of death, collected $400,000 in retirement checks. So again, we'll take 25% of $400,000, which is $100,000, subtract it from the $240,000, and the beneficiary gets a lump sum for $140,000. So another way of looking at it, whatever your account balance is when you retire, the break point at which the death benefit is gone is 4 times your account balance. So if you've got 35 years of teaching, I would guesstimate you probably have upwards of $300,000 in your retirement account. So if you have $300,000, there'll be a death benefit. There'll be a decreasing benefit up until the time they paid out $1.2 million, 4 times your account balance. On average, I would say about 15 to 18 years before the money's gone. Even though it's gone, you still get it for your lifetime. It's just the death benefit will be exhausted. Any questions on Plan N?
You know, I just wonder, are you gonna do D also?
I'm sorry?
Are you gonna do D like this?
I'm gonna do Plan C next, then I'll Plan
Okay,
A.
okay.
Okay.
Thank you.
Okay, as I mentioned before, this is the least chosen plan. Okay. You have 5 choices. You can take a 5, 10, 15, 20, or 25-year period certain. The reduction in your benefit is going to be based upon your age and the length of the period you selected. So if you're 55 and you're taking a 25-year period certain, that factor is going to be a lot different than someone who's 65 taking a 25-year period certain. Benefits are guaranteed for your lifetime. Even if you take a 5-year period certain, live beyond the 5, you get that. If you die prior to the end of that term, the beneficiary collects the balance of the term. So even if your beneficiary dies, that you retire, you die, your beneficiary starts collecting, he or she dies, it's still guaranteed. The retirement system would have to complete the payments, and I'll explain that. But in this situation here, see 5-year period certain, the option factor is 99.7%. That's what's applied to the Plan N benefit. So take the 5-year period certain at age 56, using that example, you drop about $9 a month. Go from $37.20 to $37.11. You go to a 25-year period certain, the reduction is going to be much more severe. It's about a 10% reduction. So in this case, the retiree took a 20-year period certain. So the factor was 93.1%. So instead of getting the $37.20 per month that he or she would have received under Plan N, that benefit becomes $34.65 a month. Okay. Now let's say the member died. Okay, look at this. Okay, member died after receiving benefits for 12 years. And that benefit had increased from $3,465 per month to $4,300 with cost of living increases. So now the beneficiary will step in, stop receiving that $4,300. And let's say the beneficiary now dies 5 years after. So there's been a total of 17 years paid out, 12 to the member, 5 to the beneficiary. So at the time of the member's death, the payment had risen to $4,800. Now the retirement system will have to pay out the value of the remaining 3 years of payments. That's what they call a commuted value, present value. So in this case here, even though there's 36 months left, 3 years, because it's a present value, the state will receive $4,800 times 32.04 months and receive a lump sum for $153,792.
Did you say the state or the estate?
The estate.
Thank you.
Yeah. Okay, this is not, this is kind of a little bit of a risky plan to take. If you take a 25-year period certain, you live beyond the 25 years, you still get a check, but there's nothing for your beneficiary. Or if you take a 25-year period certain and live 15, there's only 5 years left. So it's conceivable that, your beneficiary would stop receiving checks. So that's the risk you would take with that plan. I would probably take this plan under 2 conditions. I go to the doctor and he says, Bill, you got 6 months. Okay? And I'm single, but I have 2 adult children. So I'm signing up to a 25-year period, sir. So I'll be, I'll kick the bucket in 6 months, but my kids will get 24 and a half years worth of checks for $3,365. I mean, it's an enormous amount of money. Or I might take it if I'm single and I had a teenage child, and what I wanted to do is make sure that if something happened to me, that child would be able to finish college. So I might take a 10 or 15-year period certain Okay, it wouldn't cost much. But if I died, at least I would know that that child would be getting that benefit stream. So I've only had one client in all the years I've been doing my consulting take this plan. And that was somewhat of an unusual circumstance as well. Okay, any questions? Okay, Plan D. Okay, as I mentioned, Plan D, you can only name one person as a co-participant. And you notice it's referred to as a co-participant, not a beneficiary. But only one person. And you can never, as I say, you never can change it. You can elect to have your co-participant receive either 1/3, 1/2, 2/3, 3/4, or the whole amount of your pension benefit. Your benefit's going to be reduced based upon your age and the age of your co-participant, as well as the fractional amount you selected. So the bigger the amount you want left to your co-participant, the more expensive it will be. So in this situation, the member was age 56, and the co-participant is 55. So if we go with the whole amount, the option factor is 87.2%. So it's costing 13% to take Plan D for the whole amount. If you go down with a 1/3 option, reduction is fairly minimal. It's 95.6%. So dropping about 4%. Now, the fraction you've selected applies to what will be carried over to your co-participant. So if you take a 100% option and you die, your co-participant gets 100% of your benefit. So in this situation here, the member selected a 3/4 option. And you can see the benefit here under the 3/4 option is $33.57.60 per month. So in this case here, if the member died, the co-participant would then get 3/4 of that amount for his or her lifetime. So whatever the benefit happens to be at the time of death, let's say the benefit had gone up to $4,000, it would cost a living increases. Co-participant gets 3/4 of the $4,000.
And what would the N get?
I'm sorry?
What would N get? Under those same circumstances, what would Plan N get? Person that chose Plan N.
Plan N would be a lump sum.
Is the lump sum.
Right. So, remember I mentioned the way Plan N operates here. What's unique about this plan, though, if you take Plan D and your co-participant dies, or you get divorced, will pop back up to the Plan N benefit. Now, if both of you die, okay, before the money is used up, we go back to that Plan N formula. So the member had $240,000 in the account at the time of retirement, and the total benefits paid to the member and the co-participant was $600,000. Take a quarter of the $600,000, which is $150,000, it is still a lump sum of $90,000.
And that would go to the beneficiary.
Well, it would go, if the co-participant dies first, okay, benefit pops back up, you then can name a beneficiary, all right? So in that case here, it would go to your beneficiary. If you die and the co-participant is collecting, he or she cannot name a beneficiary, but it would go to his or her estate. So the estate of the retirement board would not get the money. It would go to either a beneficiary or co-participant's estate.
My husband and I are both teachers, so I was thinking.
Doesn't make any difference.
Well, I mean, because we could do back and forth, but our kids would be protected. Maybe
Well,
obviously we would leave the money for the kids.
If you're both teachers,
Yes.
it doesn't make any difference. Because this is what you're choosing at retirement. Most of the time, this is a generalization. I generally don't find too many people who are both teachers, who both are career teachers, taking Plan D. Because essentially, if your pension on your own is going to be adequate or better, there's no sense taking an optional payment plan. So when you're taking an optional payment plan, you're paying a premium to do that. Now, if there were two teachers, give an example. One is an administrator, makes $140,000 a year, put in 35 years of service, you get 70%, we'll say average salary is 150, you're gonna get 105,000 a year on the plan A. The other teacher only taught 10 years and had an average salary of 80,000, and they're gonna get 8,000 a year. Well, it's obvious that the teacher getting $8,000 a year can't live on that. So the teacher who's getting 105,000 would probably take Plan D to protect the spouse. And the teacher who's getting 8,000 a year would take Plan A, right? Because there would be no sense in that teacher trying to, the teacher getting 105,000 doesn't need any. So each situation is a little bit different, and it's a good segue here actually, because as I mentioned, everybody's different. So in this case, there's 5 different cases here, but you can see here, the first case, single teacher, no dependents, just nieces and nephews, no need to leave an estate. So which plan do you think a teacher would choose? What do you guess? Yeah, exactly. Here's, I think I gave the answer away already on this one. Single parent, age 56, 15-year-old in high school. Teacher's not in good health, has little in savings, minimal life insurance. What plan?
C.
C. I'd go with probably a C for, I'd probably go for at least 10 years, maybe stretch and go to 15. Case number 3, get a professional couple, both have large pensions, lots of money, lots of cash. They could live on their own, they don't need each other's pension. What do you think they should take? I'd go with N. You don't need it. It's like buying insurance and that you don't need. So if you have more than, basically you're self-insured. So if someone comes to me and they have a home in Wilton that's worth, $900,000 or $1 million, it's all paid for. They have $500,000 in TSAs, a couple $100,000 in savings and stuff. They're self-insured. They don't really need to take payment plan out. There are some people out there who will encourage you, in some cases, to take Plan N and go out and buy a life insurance policy instead of taking Plan D. In my opinion, you can't beat the option factors that the retirement board uses to reduce your benefit. Okay? You're probably not going to be able to get a better deal trying to get life insurance. So here's another one. Married administrator, spouse has a small pension and Social Security. Administrator has a $1 million life insurance policy, $500,000 in the TSA, home $600,000 worth of equity. I'd go with them. They don't need, there's no sense getting D because they have so much in assets and equity. And finally, the last one. Married administrator has a spouse, small Social Security benefit. Administrator has $100,000 in life insurance, owes $150,000 on the mortgage, has $50,000 in savings, has a TRB balance of $300,000, and is eligible for a TRB pension of $75,000 per year under Plan N. What do you think might be a viable plan there? I would probably go with D. It doesn't have to be the 100% option. But in this situation here, I don't think the spouse could get by for life with a Social Security benefit, say $1,000 a month, $100,000 in life insurance, $150,000 mortgage. This is where that person probably needs some form of protection. That's why I wanted to illustrate that Everybody's situation is different. Even though 75% of people take Plan N, they're all different. Okay, how many of you began teaching before 1989? Probably most of you. Okay. If you began employment prior to 1989, you were contributing, in the old days, you were contributing 5% for retirement and 1% as well. They went into a supplemental. So starting in '89, they changed that. So the 1% you've been putting in since 1989 now goes into a health fund. And that's what's used to fund the health insurance benefits, that subsidy you were talking about. Actually, that amount has gone up to 1.25. So if you have 1% contributions prior to '89, if they belong to you, all right, and they continue to earn interest each year. There's no new money going in. In addition, you can also put in voluntary contributions. So right now, you pay 6% towards retirement, 1.25 for health. You can also make voluntary contributions. Over and above that, it goes into a voluntary account. I'm going to mention it. I wouldn't recommend doing it. Up until last year, it was a pretty good deal because they used the credited interest rate to evaluate the contribution, how much your balance would be, which was pretty good because it was running, some years it was running 13, 14%. Last year they switched to a market value. So people who have voluntary contributions, when they get their statement next week or so, they're actually going to have a minus 1/10 of 1% loss. So especially in this market where things have tanked, I wouldn't put a nickel into the voluntary account prior to retirement. Okay. Now when you retire, you have a number of options you can do. The first option is you can leave it with the retirement board, and they'll give you an extra, what they call an annuity, extra annuity. So that annuity is going to be based on the amount you have in your account, your age, and whatever option you selected, whether you take Plan N, C, or D. The second choice is to take a lump sum, have it paid. When you take a lump sum, you have two choices. It can be paid directly to you, or you can roll over the taxable piece. The third choice is you can use the 1% account, the voluntary account, to buy your service. So if you have 2 years of time to buy in, you could use your voluntary account or your 1% account. You can use your voluntary account to buy service anytime. But the 1% account, you can only use that to buy service at retirement. You can't do it pre-retirement. So here's, this is what the balance looks like. The, let's see here. The 1% account, balance of $20,000. Voluntary account, $27,000. At age 56, the annuity rate, and these rates have actually changed since I did this slide, was $8.18 per month per thousand. So in this case, the $20,000 would generate $163 a month, $163.60, and the $27,000 would generate $220.86. But if you took Plan C or D, it would be reduced based on that option factor. Right now, I can tell you the annuity rate, if they change, for age 60 is $8.12 per month per thousand. So, which is a great return. So, for on a $100,000 investment, you get $812 a month. So you'd be getting $9,700 a year, fixed, and guaranteed for life. It never goes up, never goes down. What you can do is you can put money into the voluntary account when you retire. This would be my recommendation if you're going to do that. You can use pre-tax funds, right? Unlimited. So if you have tax sheltered annuities, so you want to put $100,000 into that voluntary account, you can have it transferred in. You can only do this at retirement. put it into the voluntary account, and then collect an annuity. So the only downside is once you put it in to the voluntary account, it's locked in. You can't come back a year later and say, I'd really like my money back. So it's locked in, so you have to consider that. Okay, I wouldn't recommend anyone put your entire life savings into the voluntary account, but it provides a really great return. Right? Yes?
Could you take that lump sum out and put it in, I don't know where, but save it for insurance, and so therefore it wouldn't be taxed, or there's no way around that?
If you take it out as a lump sum, there's two things that will happen. If you take it out directly, you're going to have a major tax liability.
Because it'll be on the year of tax.
Well, what happens is, you see here, it says after tax, 4,000, interest 16,000, total 20
Yeah.
on that 1% account?
Yeah, right.
So if you took that out, that 1% account out, the only thing that's not taxable is the 4,000. You've already paid tax on that. The 16 is subject to federal tax immediately. Plus you're going to get hit with state tax and possibly a penalty.
So you can't just take it and move it into
But
an
what you can
account.
do with it, conversely, you could take that, say you wanted to take that 1%, the 20 grand, you could roll it over, okay, into an IRA or a TSA and defer your taxes. So if you decided on the rollover option, the retirement board would then send you a check for 4,000, which belongs to you, you've already paid taxes on it. And the 16,000 would go into an IRA or a TSA.
And could you draw from that for your insurance? Pay for your
Well, you can
insurance?
draw for wherever you put it, okay? You would say you put it in with Fidelity or Vanguard or whatever. Certainly you can draw down.
And you pay taxes then?
As you take it out, it's taxable.
Okay, so at least it'd be
In
taxed
fact,
at that current.
at age 70 and a half, they have what they call a minimum distribution rule, and you have to stop drawing down on your TSAs and IRAs. Okay, any questions on this?
Annuity, is that something that's run by the TRB, or is that, I'm just trying to figure out how safe it is. Could it go bust?
Well, if you annuitize it
Yeah,
with the retirement board, guaranteed.
because Fidelity is not
Fidelity,
protected.
I mean, yeah, Fidelity, you could, say you had 20 grand, and you took it out, and you put the 16 in Fidelity, the Fidelity IRA, and then you took the 4,000 and you put it into a Fidelity non-IRA, all right, and they're both mutual funds, we'll say, and the market drops, your 20 grand drops.
Right, but the annuity is, you leave it in. I just
Right.
want to make sure it's run by the TRB.
Right, if you leave it in,
guarantee-
okay,
Is it guaranteed?
you put in, we'll say you put $100,000 into the voluntary account with TRB. You get, and you were age 60, today it's $8.12 per month per that. So you collect the $8.12, absolutely guaranteed for life, no matter what happens.
Guaranteed by whom?
Guaranteed by the tax system. And if you die, whatever money is left over goes to your beneficiary. So if you take Plan N and you put $100,000 in, using that formula, the 1/4 formula, basically $203 a month is coming out of your $100,000 for death benefit. So factoring in everything, to me it's a great deal. No risk, guaranteed. Yes?
I have another question. Down here it says note, if you choose optional, I can't quite read, optimal payment plan, C or D, you're gonna be reduced.
Right.
Why would that happen when one has nothing to do with the other?
Oh, they do, because it's part of the plan you've selected. So whatever happens, whatever plan you choose, that annuity follows.
Well, I have 1% or whatever here.
Right.
And I have $34,000.
Okay, let's use this example here. And using that factor, all right, if I take Plan N, the 20 grand.
Say I take Plan D, I don't know, it
All
says
right,
C or D.
all right, but I want to show you first, we have to start off with Plan N.
Okay.
So if you take Plan N, you get $163.60 a month. Okay? That's the maximum you can get.
That's per monthly. Is this just to do with option one? It doesn't, if I took the whole amount out, I wouldn't be affected by that?
Well, if you're taking the amount out, you're not annuitizing it.
Oh, okay,
Yeah.
okay.
But if you took Plan D, instead of getting 163 a month, that benefit might be reduced by 10%, okay, depending on the option factor.
Okay.
Yes.
If I'm buying back years out of that, and there's money left, and then that money that's left
Good
go
question.
into an
Okay.
annuity?
Let's use the 1% account. Right. The first thing they do, let's say you get a bill for 15,000, and you have 20 grand in your account. They're going to take the 4 grand first, the after tax. Now we need 11. So they'll take the 11 out of the interest. There's $5,000 left, which is interest. You would then have to take it out of the lump sum. Okay, to annuitize. You could then do a roll of the interest into a TSA. So once you decide you want to use those accounts to buy service, then there's no other option except for you to get a lump sum. But they do give you the choice whether it's paid directly to you or a rollover. Okay? Okay, I think that pretty much covers it. Okay, let's see, buying service. Okay, up until 2004, you had to wait until retirement in order to buy your service. So in 2004, they changed the law, and you could buy your service at any time. Like I say, I think there's about 13 or 14 different types of service. They keep adding on to the list, like Peace Corps and so forth, and Vista. They use what they call an actuarial cost method. Okay. Again, I mentioned what you can do is you can use a tax sheltered annuity or an IRA or any other pre-tax vehicle to buy in that time. And if you have a voluntary account, you can use that as well. If you have time to buy in, and this really depends on the marketplace, I normally would tell people use your TSAs, IRAs to buy in the time. Use pre-tax money. But the problem right now is the market is going so bad that if you pull it out, transfer it, you're kind of like taking the loss. Or you might just say, well, I'm going to ride it out. But my general recommendation would be, if you have time to buy as much as you can. And the sooner you buy it, generally the cheaper it is. That will vary from case to case. But again, you can only use the 1% account every time. And if you do, whatever is left over, pay the lump sum. Okay? And I'll show you a couple of examples here. So the first example was the teacher's age 56 for 33 years and wants to buy in 2 years of out-of-state service. So in this situation, the cost, if it was purchased in July of 2006, it would have been $28,727. But the following year, remember, waits one more year, another age 57 with 34 years, and the cost actually dropped. Right? That's not the norm, but there are deviations because it's an actuarial cost method. This example 2 is more likely the scenario where the teacher's age 54 with 25 years, buying in 5 years of out-of-state service. Purchase cost in July of 2006 would be $33,272, and they wait one more year, it goes to $36,119. The typical increase, in my opinion, is usually about somewhere between 8 to 10% would be the norm. Now, what you can do is you can go onto the TRD website and they have a calculator, and you can run the what-if scenarios. The general rule of thumb is that the cost of buying the service is usually about 5 times the amount of the annual increase you will derive from buying that service. So let's say you're buying in 5 years of service. So you have 30 years, and you're buying in 5 years of service. Well, the extra 5 years will bring you from, we'll say, 60% to 70%. So So it's a 10% increase, and your salary's running 80,000. That's going to bring you, your average salary's 80,000. That's going to generate another 8,000 a year. Your cost would probably be about 5 times that. But the best thing to do is go on the TRB website, and you can run your own numbers. Okay? Now, the other thing I want to tell you, that method does not apply to someone who taught in Connecticut previously, or pull the money out. So let's say you taught from 1972 to 1974 in Connecticut, took your money out. Right? You don't use that method. Right? What they actually do is they look at how much you withdrew, when you withdrew it, and then add interest the date you paid it back. Right? So it's just as if the money had been in your account during that period of time. I'm going to go very quickly and briefly over this. I know it's getting a little bit late. But this question always keeps coming up about deferring benefits. So here's an example of a teacher who's age 55 or 30 years. Could walk out the door, collect right then and there, 51% as an early retirement, and get $30,600 a year. But that teacher decides to, they want to wait to 60 and avoid the quote penalty. So
May I have your attention, please, extended learning program instructors, tutors, and students. We now have 4 buses outside, and we've got vehicles for you to ride home in. Cars, trains, trucks, RVs, helicopters. So come on down and pick your ride. But our session is ended today. So gather your things together and come walking, talking, no running, no shouting, no jumping, no leaping, no, you know the routine. Come on then, time to go.
It's a tough act to follow. Okay, so this teacher decides to wait until 60, and in that case it's a normal retirement. It's 60%, it's $36,000 a year. But if you look at what that teacher would have collected from 55 to 60, they would have collected $30,600 for 5 years, which is $153 grand. And they would only gain $6,000 a year, okay, typically. Now, you have to remember that 30,000, well actually they're going to gain $5,400 a year. But you have to remember, if that teacher had retired at 55, they would have collected cost of living increases on that benefit. So I haven't even factored that in. But in this example, it would take 28 years to break even. I know some of you might have 34.8 or whatever it might be, and say, well, yeah, I want to round it off. It's not worth it. Right? It's not worth coming back to school for 2 months. Or let's say that your birthday, you're going to be 60 in July or August, and you want to wait until September, not worth it. Because retirement board counts every single month, right, full month, towards a retirement credit. And they also factor in every single month how close you are to normal retirement. So if you're 59 years and 10 months when you retire, it's early retirement, you're only 2 months early. Right? The reduction is minimal. Right? So forget about your birth date and forget about getting, I've had teachers actually with 34.9 go back for 1 month to get the 35. And then if you factor in, well, how much would you have collected for July, August, and September to gain $12 a month? That's what it boils down to. So, collect, basically, the bottom line is collect as soon as you can. Right? I'll just mention this real briefly, but sometimes people will take what they call a leave of absence. The only time I would recommend a leave of absence would be for some critical piece. It probably won't apply to anybody in this room right now because I think you're going to go July 1st. But sometimes people will take a leave of absence just to get another year of credit. And of course, they have to pay in to leave. They've given up a year's worth of checks. It's not worth it. But I would take it a leave of absence. Let's say I had 24.9 and I needed to get to the 25th in order to collect. I'd take a leave of absence. or I quit at age 47 with 14 years, I'm not coming back, we'll take a leave of absence for a year, pay you and get the 50th year. But for the most part, I wouldn't recommend doing it. Any questions on this? All right, that illustrates it. Okay, taxes. Before 1991, the contributions you made to the retirement system were on an after-tax basis. So when you look at your annual statement, you can see that it says regular contributions, after-tax, 1% contributions, and so forth. Then it will show pre-tax contributions. It will also show interest. So when you retire, the IRS allows you to get back the money you put in on an after-tax basis. But they spread it out over your life expectancy. So in this example that I have, the teacher was age 56 when he or she retired and had put in $36,000 after-tax contributions. Well, at age 56, the IRS says you can recover that over 310 months. So in this case here, take the 36,000 divided by 310, and that retiree gets $116 a month tax-free for the next 310 months. Then after that, it becomes fully taxable. But for most of you, you're probably going to be 97% of your benefit will probably be taxable. The good thing is the retirement board, when you get your tax statement when you retire, after the year after you retire, your 1099-R, they will figure that out. Okay? But most of it's going to be taxable. Okay. Social Security. Right, there's two different provisions I want to talk about. The first one is if you're claiming Social Security based on your spouse's work history. There's a federal provision of the law called the government pension offset, and it essentially affects any person who's collecting a governmental pension not covered by Social Security, which in this case would be Connecticut teachers. But there is an exemption. If you qualified for your TRB pension prior to December 1, 1982, you're exempt. Okay? But when I say you qualified, that means you could have walked into the retirement board in December of 82 and actually retired. Right? So that means back then you had 25 years of service, or you were age 55 with 20 years, or you were age 60 with 10 years. And I don't think there's anyone in this room who comes close to that. Okay? So what happens in this situation, if you apply for Social Security benefits based on your spouse's work history, let's say no, you're a teacher, not covered by Social Security, they'll take your TRD pension, they take 2/3 of that pension amount and apply it against your spouse's Social Security benefit. So let's say your spousal benefit would have been $600 a month, and your TRD pension was $2,400 a month. You take 2/3 of the $2,400, which is $1,600, and which is greater than the $600 claiming for Social Security, it wipes it out. Okay, so any questions on pension offset? Even though you're not eligible for Social Security benefits, right, because of the offset, you still qualify for Medicare based on your spouse's work history. Okay. Now, if you are divorced, okay, you were married for 10 years, okay, if you haven't been married, you can still qualify for Medicare at 65. Okay? Yes?
If you still had all those quarters and you're a teacher, but you also have 40 quarters Social Security, you are entitled to a certain amount
Yep.
of Social
Next
Security.
slide. Okay, that's a different one. All right, so now we're going to talk about claiming Social Security based on your own. You have your own 40 quarters. Okay. So it's kind of the same rule, except there's an exemption if you qualified for your TRB pension prior to January 1 of '86. Same rules that I mentioned before in terms of age and service. You're also exempt if you had 30 or more years of substantial Social Security earnings. Right, so, Social Security does have a table which will show you what is considered substantial each year. What I do for most of my clients who have Social Security, I go onto the Social Security website and I enter their earnings history year by year, and that will actually calculate the Social Security benefit. So you can go on the Social Security website and use what they call the WEP calculator, and you put in, your age you want to collect Social Security. We'll say 62. Put in your date of birth. You put in your earnings history. You put in your TRB pension, and it will calculate it. Rule of thumb: you probably, if you had minimal Social Security earnings, just had your 40 quarters and you worked a lot of summers and stuff, you probably get about 40% of what it shows on your Social Security statement. So if it says you're going to get $150 a month, right, that doesn't factor in the windfall elimination provision. So if it's 150, you probably get about 40% of that, which would be about $60. So it's based upon a formula, but just to give you an idea, I haven't updated the slide in a while. For 2003, substantial earnings were $16,125. The simplest thing is just go on to the Social Security website. Okay, cost of living. Okay, if you retired, most teachers retire July 1st, I would say. 90% of all retirees are July 1. But if your retirement date is anywhere between May 1st through October 1st, your anniversary date for cost of living increases is July 1. So if you retire July 1st of 2009, then July of 2010, you'll get your first cost of living increase. It's predicated on the Social Security COLA. It's also a function of how well the retirement fund does preceding year. Now, I think for January of 2009, Social Security is scheduled to pay 5.8%. Now, that's nice, but unless the retirement fund earns 8.5% on June 30th of 2008, all bets are off. Okay? So in that case, because I know, I'm quite sure the retirement fund didn't earn 8.5% last year, the minimum will be 1.5%. Now, had they earned 8.5%, then the retirement system would have paid that Social Security COLA of 5.8. But over the period of time since this new COLA went into effect, which is 14 years ago, it's averaged about 2.3. So, in this case here, I know in this coming January, the COLA will be 1.5% because of the fact that the retirement system didn't earn that 8.5% on the fund balance.
Guaranteed, I'm assuming that's because of the market value, that the retirement board didn't make the money because of, what's going on in the economy today. Can our retirement ever be touched? I know it was a promise, that it's supposedly not. I mean, I don't mean the cost of living, obviously that can be.
Yeah,
but I mean our bulk of our money that.
Well, you could, conceivably, let's say Social Security, I know there was a year or two where Social Security actually came in at 1.3. All right. Normally, you would get 1.5, but because Social Security COLA was only 1.3, that's what the retirees got.
Okay, that's the cost of living. And I understand how that could vary because they're using our money to make money.
Now, it could go as high as 6%.
Which is great. What I'm speaking of is kind of ring a bell, that what about the money that, going back to our basic retirement fund, our $3,000 or $6,000 per month, the basic amount of money that is our retirement.
Yeah, that's guaranteed. Anything that
guaranteed.
Once you get into pay status, whatever you are getting, you have a contractual right for.
Okay, so that's not going to be, it can't all of a sudden be affected by the
They can't
economy.
decrease the benefit. So
Somebody
you
can
retire
say-
and your retirement benefit is $4,000 a month. on July 1st of 2009.
So, yeah, right.
Next year, you get a 2% COLA in 2010. Now you got $80 more. Your benefit is $4,080. Guaranteed. Can't go down.
Right, in other words, that,
Right.
whatever the market value is
Right.
and that kind of thing won't affect.
But
the money
let's say that the following year, the cost of living increase is only 1%. Then you get 1% based on the 4,000.
Right, right. I mean, I understand the cost of living.
Yeah.
I just want to make sure that my basic retirement's not being,
The only thing is, too, I'll mention is that the annuities, the 1% involuntary annuities, do not get a cost of living increase, just your base money. Okay. Okay, health insurance. Okay, basically, the first part is for teachers not eligible for Medicare Part A, the hospital insurance. Your last employing Board of Ed has to offer you health insurance to you and your spouse, as long as you do not have Medicare Part A. Okay? And they have to offer you the same coverage that's offered to active teachers, so they can't carve out a plan for retirees that would be substandard, so to speak. Okay? So you have to get the same coverage. When that includes dental, prescription drugs, so be it. You can enroll at any time. So you don't necessarily have to enroll when you retire. Right? There may be a situation where you have a spouse who's working in another school district, working for the state, working for some company, and you can get the health insurance at a much better cost. You go that route. But when that coverage dries up, you can always go back, as long as you're not getting Medicare. So you mentioned the state kicks in a subsidy of $110 for the retiree, and also $110 for the spouse. Right? So it also applies to a surviving spouse. So even if you die and you have a spouse, that's a surviving spouse, can still get his or her coverage through the last employing Board of Education. Okay. And that subsidy has to be applied first towards your costs. Right? Some towns have a contractual provisions where they might make a payment. They may pay 20%, you have to pay 80%. Unless the contract is written contrary, the subsidy has to go towards your costs first. Okay? Not too many districts that do this anymore. TRB also offers a Medigap plan. All right, once you have Medicare Part A and B, it's a great plan. They offer basically 3 plans. The basic plan, which runs $99 a month, and that's hospital, medical, major med, prescription drug. And let's say $99 a month. Can't beat that. That's for January 1st of 2009. If you want dental added onto it, it's $144 a month. And if you want the whole package, which includes dental, vision, and hearing, it's $149 a month per person.
Over and above the 99?
No, that's the total. So it's 99 basic, 144 adding the dental onto it, and 149 for the complete package. So in addition to that, you pay your Medicare Part B, which is running about $97 a month. So if you took the best plan, you pay $149, which would be deducted from your TRB check, and $97, which would be called your Social Security benefit. Okay. Any questions on health insurance? Does anybody want me to talk about disability benefits, or?
Disability benefits for the system? Disability benefits as a school teacher?
Yeah. If most of you in this room have 30-plus years of service, even if it's an early retirement, you can beat out a disability benefit. It's just important to know that the Retirement Board does offer a disability allowance if you become disabled. The thing is, it maxes out. When you have 25 or more years of service, it maxes out at 50%. So it would really depend on circumstances. If someone became disabled, now if I had a teacher who was 55 with 25 years of service. If they took an early retirement, they would get 35%. Right? If they took disability, they would get 50%. So, if you want me to go through this, I'll let you know. Consensus? Okay. This section here really talks about pre-retirement death benefits while you're actively teaching. Once you retire, okay, the death benefits are going to be controlled by the plan you've selected, whether you take Plan N, Plan C, Plan D. But under this scenario, let's say you decide not to retire this year, and you die, okay? You're dying before you actually retire. If you die before retirement and you have no statutory survivors, so you don't have a spouse, you don't have any minor children, okay, or dependent parents, what would happen in that case is the balance of your account, okay, would be paid in a lump sum to your beneficiary. And it would also be a lump sum death payment for burial expenses, okay, and that ranges from $1,000 up to $2,000. So if you had $240,000 in the account, you died, you had no survivors, we'll say the $2,000 would come out of the $240 for the lump sum death benefits. The $238 would go to your beneficiary. Okay. Now, if you die before retirement and you have statutory survivors, say a spouse or minor children, if you have 12 or less years of service, your spouse will get $300 a month. And an additional $25 a month for each year of service above the 12 years. So the maximum spousal benefit is $600 a month. And that would be paid to the spouse provided he or she does not remarry prior to age 60. If you have minor children, they would get $300 a month until age 18, and the maximum family benefit is $1,500. Again, there's a lump sum death payment either up to from $1,000 up to $2,000. Now, this is the big one here. This is if you die before retirement and you're eligible for retirement. Now, if you meet the age of service requirement, so let's say you were 55 with 20 years, you had 25 years, you were 60 with 10, any way you could retire immediately, your spouse can elect any one of three benefits. But to have that option, he or she has to be named your primary beneficiary. So, in the example we had, sample computation, member had $240,000 in the account. So the spouse was named primary beneficiary. So door number one is take the $240,000. Door number two is to take the statutory survivor benefit, which would be $600. And door number three would be to take the benefit that was equal to Plan D 100%, and that would be $3,245 a month. That's just as if you had retired at the time of your death and selected Plan D 100%. So that one's a no-brainer. But the important thing is your spouse has to be named primary beneficiary. You have those choices. So if you forgot to change your beneficiary and then your cousin was, the only choice your spouse would have would be, who actually wouldn't have a choice, would get the $600 a month. So, yes?
My beneficiaries, my husband and my three kids are under them. But I
Sorry?
mean, I have like four people, my husband and my three children are under it.
Okay.
But he would be primary because he's first, right?
Well, if you say, for example, you have your husband as your primary beneficiary and your children as contingent,
I mean, I'm assuming it's because of something happened to both of us. Yeah, I mean, we would
Yeah.
go down.
but I mean, if you name your spouse as primary beneficiary and your kids as contingent, then your spouse would get these three choices. Now, if you named all four of them as co-beneficiaries, and they're all, I assume they're all over 18, your spouse could conceivably get that benefit, but your three children would have to waive their rights to benefits. It's not something you want to get into.
Yeah, I'd have to look, I mean, I think when I filled it out, I think I put the primary and I could put them
Yeah, when you get
down.
your beneficiary thing, it will show you primary, contingent.
I thought when I read something, it just had them all four. I saw them,
Now, once you retire,
check that out.
once you retire, you're gonna do your retirement application. You're gonna put in your plan and how you want your beneficiaries.
Right, if I died right now.
Yeah. Well, I would do is check your annual statement when you get it, hopefully within the next week or 2 weeks. And you can download the form off the TRB website and send it in if you want to have your husband as primary and your kids as contingent. But if you have them listed as all primary, that could create a problem if you die before you.
Right.
Okay.
Not plan, just not that I plan on dying. Right, it's not something we really want, but, we just would need to see.
We're almost
I think
there.
this would be fun.
Superintendent, assistant superintendent. But also apply if you took a job at any of the state community colleges, state colleges, let's say UConn. If you go out of state, there's no restriction on your employment. And if you go to a private school, say any of the private colleges, again, there's no restriction. And you can see here, this is the list. Copy of your birth certificate and a copy of your birth certificate of your co-participant if you're taking Plan D. You're going to have to choose your retirement payment plan. You're going to either take Plan N, Plan C, or Plan D. And if you can file it quarterly, but most people will have the retirement board figure it out for you, based on the tax tables. Married, claiming one, single, zero, whatever. As far as state taxes, if you're a Connecticut resident, you're going to be liable for Connecticut state income tax. I usually tell my clients, take out 5% of whatever your benefit will be. So if your pension benefit's going to be $4,000 a month, 5%. Go into your checking and savings account. If you retire July 1st, you will get your first benefit payment at the end of August, the last business day in August, but it will be retroactive. You will get 2 checks, one for July and one for August. As far as notification, the retirement board will send you a notice when you get your first payment at the end of August. Then you'll get another statement at the end of September, because in August you'll be getting 2 payments. In July, in September you'll be getting 1. So anytime your benefit changes, they will send you a notice. So you probably won't get another notice until the following July when you get your first cost of living increase. But anytime there's a change, even if you initiate it, you want to change your withholding taxes, federal or state, you'll get notification. Okay. So that pretty much concludes my presentation. Is one more slide. Basically, it's something that you can take a look at at your leisure, and things to consider before you retire. I was trying to evaluate, where you stand, what your expenses are, and those types of concerns. So, thank you very much.
Thank you.
I have 2 questions. If you're collecting a military pension and military disability, how does it come off of this, or does it reduce?
You can be collecting. You as a teacher, no problem. No effect at all.
No effect of this?